Compass co-founder and CEO Robert Reffkin joins us here at Post 9. Nice to see you.
Nice to see you as well.
How much activity does a move in mortgage rates from 8 to 6.5% unleash?
Well, we see over cycles that buyers react more to the change in the mortgage rate than the actual mortgage rate itself. And it suggests that next year will be a very good year. A key question is, will the Fed lower rates in the March meeting before the spring market or in the May meeting afterwards? Look, 2023 was the worst year in transactions since 1993. And for the first time, all of the key metrics on the inventory side and the buyer side are pointing the right direction. We have 4% more inventory ending the year than we did last year, so inventory is building. And again, buyer demand was high even with 8.1% mortgage rates, and now it's 6.5.
What's driving the inventory? People finally feeling like they can sell?
Yeah, look, sellers are adjusting to the new normal, and you can only hold back the life events for so long. We've talked about the 5 Ds, diapers, diplomas, diamonds, divorce, and death. That keeps the market moving, and it forces inventory to be brought to the market.
Not that much, though. I mean, it's still at the margin, but it feels like that flood of actual sellers and or at least creating a market that would allow buyers to really benefit is not there yet.
Yeah, that's a very fair point. We're not seeing a flood of inventory, just a modest amount of inventory. 4% more than last year off depressed levels isn't that great. And although it's 4% more inventory than this time last year, it's 39% less inventory than 2019 before the pandemic period. So very fair point. But after a period like 2023 of meaningful contraction, this does suggest that 2024 will be modest expansion because more inventory equals more sales.
We've been through cycles. We've been through this part of the cycle before, though, but not where work from home was as universal as it is. Does that make this one different than past cycles?
Yeah, work from home is also a modest catalyst to movement because CEOs realize that you can't build a great culture virtually, and if you can't have a great culture, you're not going to have a great company. So they are slowly bringing people back to the office, and those boom towns, which benefited from the work from home era, are slowly bringing inventory to the market more than others.
So what is hot? Where do you see the most demand?
The hottest markets are what we call the spillover migration markets. Now, those are markets that are adjacent to core markets that are becoming too expensive. So San Francisco, people are moving from there to Sacramento, from Austin to San Antonio, from D.C. to Raleigh.
And what about rents? I mean, I know, but that's, it's sort of a component of your overall business. We have started to see declines. What are your expectations as we move through 2024?
Yeah, in this period of inflation where rents are a big contribution to that, a big factor, one of the best signs we're seeing are around rents. Rents have declined every month for the last 5 months. We saw in November the sharpest decline in 3 years. In Manhattan, which has seen 27 months of rental increases, saw the first time a rental decline.
Why? Because inflation is coming down finally?
Yeah, we're seeing deflation in the rental market because there's too much inventory on the rental side.
You going to hire more people next year to get ready for this actual increase in business, or you're okay?
Look, at Compass, we are committed to keeping our costs low, even when the market does come back, so that we have meaningful expansion in EBITDA, which we can share with our investors.